Hey y'all, how you doing? Coming to you from the cockpit of the F-15, I believe it is. Top Gun F-15. How you doing? Greg Silverman here, CIOs and bow ties. And this is my series called Come Learn With Me, where we go through some of the articles that you all have liked and shared over the last week. We definitely are on a inflation trend as articles around inflation are surfacing. Here's a good one. Come learn with me. Worried about inflation? Here's how investments did in 1970s. Okay. Let's have oil, not bonds. Total return. It's 1971 to 1981, so 10-year period. Energy stocks 73%. Were the best. Treasuries were the worst. -38. In the 90s, an old newspaper man explains to Kevin Spacey how to cover the news. If there is a storm visible anywhere, he explains, you write, storm threatens the town, even if the storm is nowhere near and is unlikely to hit. If, as expected, the storm never hits, you just write the follow-up, town spared by storm. Readers may be excused for thinking something similar about the latest stories about looming, threatening, surging, terrifying, yes, inflation. Yes, the inflation forecasts were surging and hit 8-year highs. Let's just check when this article was published. Some of them can be a little July 19th, and we're now in September 2nd. So okay, a little over a month and a half, not still relevant. And you can listen to the article. Great. Yes, inflation, had they continued, there would be grounds to worry, but they haven't continued. On the contrary, they've been falling for 2 months. The bond market's 5-year inflation forecast is now lower than it was in mid-March. Around 2.6%. That's higher than we've been used to for a decade. That is nothing to cause any significant alarm. That can change, of course. Maybe it will. We'll see. But with all this talk, I got to thinking about the obvious question. If serious inflation really does hit, what can we do about it? How can we protect our investments? That's an especially key question for today's retirees and those expecting to retire soon. When we're older, we're generally advised to keep most of our money in more conservative investments, meaning things like bonds that involve less risk. Someone in their 20s or 30s may not worry unduly if their retirement savings plunge 30% in a market rout or an inflationary spiral. For someone in their 60s, let alone older, that can become a major financial crisis. Just a few points to highlight when we're older. We know inflation is not good for bonds. So I went back and dug up the information from the last infamous inflationary spiral in the 1970s, when consumer price inflation often topped 10% a year. The Greek philosopher Heraclitus pointed that out, that no one ever walks through the same stream twice, because the second time it's not the same stream and we're not the same person. Everything changes. There is no guarantee the next inflationary boom, even if it happens, will look anything like the last one, any more than we should assume that it will be accompanied by outbreaks of disco music and flared jeans. Oh, that's a pity. Nonetheless, the chart above shows the total returns after adjusting for inflation of various asset classes from December 1971 to December 1981. I use those dates because the National Association of Real Estate Investment Trusts, or NAREIT, starts their data series then. The data on energy stocks come from data compiled by Professor Ken French at Dartmouth College, Tuck School of Business. This is what happened. Let's just check. Whoa. Okay. This is where are we? This is what happened. Your purchasing power, if you invested in these assets and hung on for 10 years. I've excluded gold, which is a different story. The key standout is that you really didn't want to own Treasury bonds. The near 40% loss of purchasing power over 10 years is somewhat notional, is derived from a compound annual returns on 10-year Treasuries compiled by New York University Stern School of Business, divided by the Consumer Price Index, but tells a story nonetheless. In Great Britain, where inflation was even worse, government bonds during the 70s became known as certificates of confiscation. Ouch. Well, maybe even negative interest rates are certificates of confiscation. Anyway, Let's just leave it at that. Bonds did bad. Holding them cost you money, lots of it. You could argue that the danger today is even greater simply because the yields on long-term Treasury bonds are so low. Federal Reserve quantitative easing, bond buying, and zero interest rate policies have left Treasury yield on record, which means the turns would be a disaster if inflation reared its head. Corporate bonds on the S&P 500 were also in terrible investments. It's worth remembering that these are real-term losses over a decade, which means investors didn't just lose a lot of money, they also lost a lot of time. Utility stocks weren't great, but they held up better, and Treasury bills, short-term paper, did better still. But once again, you were going backward, and you needed to be going forwards. Oh, excuse me. No way. Oh, wow. No one remembers the 70s will be surprised that energy companies boomed. Less well remembered maybe is that REITs also did pretty well. The numbers incidentally represented property owning REITs and excluded mortgage REITs, which owned loans. Okay, good to know. Loans are like bonds. But there are two caveats to this. The first is that, of course, energy stocks did well because a key driver of inflation in the 1970s was the rise of OPEC and 2 oil embargoes imposed on the West for political reasons. Q. Heraclitus. There is no particular reason to assume that the next inflationary surge will be the same. The second caveat is that although REITs ended up doing well, they were volatile along the way. In particular, REIT prices collapsed in the OPEC-driven recession of 1970, and according to FactSet, US REITs today already look pretty expensive on some measures. For instance, it reckons that the forecasted dividend yield on the Vanguard Real Estate ETF, a reasonable benchmark for the industry, is just 2.9%, by far the lowest since it was launched in 2004. Looking through NAREIT data, I can't find a moment since 1971 when the overall yield on REITs was this low. During the real estate bubble in 2007, incidentally, the yield bottomed out at no lower than 3.6%. So it may be that REITs offer less inflation protection today than we hope. One key difference in the 1970s is that there was no inflation protection bonds to keep investors protected. So-called TIPS are in theory issued by the US government, and their coupons are safe against default. Meanwhile, their coupons effectively reflect changes in consumer prices. The problem today is that TIPS, like almost everything else in the bond market, looks incredibly expensive. Most TIPS already lock in an actual loss of purchasing power if you buy them today. For example, if you buy 5-year TIPS bonds and hold them for 5 years, you'll end up losing 9% of your purchasing power. And 30-year TIP bonds offer the same 9% loss, although stretched out over 30 years. It's not very compelling, and it shows the risk that the government's policy responses have created for those in retirement and near it. Just out of curiosity, let's just see what the S&P. The S&P was down 16, same period. Utilities a better, T-bills a bit better. Okay, interesting article. Let's see. History never repeats, but it merely rhymes. Thanks for joining.